Thank you for tuning in to LeadDeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at LeadDeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
Welcome back, everybody, for another deep dive. Today, we're going to be tackling a concept that's really important for making smart real estate decisions, and that is the time value of money. And to help us guide this discussion, we've got some excerpts from the article, Using Time Value of Money for Real Estate Valuation.
Yeah, it's a topic that I find really fascinating.
Yeah.
It's relevant even if you're not a financial expert per se.
Yeah, I mean, we kind of all know that, money today is worth more than the same amount in the future. But, there's a whole science to it.
Absolutely. Yeah. And I think that's what this deep dive is going to help us with, is to kind of unpack the why behind that statement, because the earning potential of money over time is really a force to be reckoned with.
I keep thinking back to that example in the article about having dinner with a friend.
Oh, yeah.
It just makes the concept so tangible. Having $20 now to treat your friend to dinner is way more appealing than waiting 10 years to get that $20.
Exactly. And so that same principle applies to real estate. A dollar invested today has the potential to grow significantly over time. And that's due to factors like interest rates and compounding.
Okay, so let's break down those factors. The article mentions interest rates, time, and the starting point of the cash flow as key influences on the time value of money. So what makes those so important?
Well, you can kind of think about interest rates like the engine of growth for your money. So a higher interest rate means your investment is going to grow faster. And then the longer you let that money work for you, the more time it has to compound.
Which brings us to the power of compounding.
Yes. This is where things get really exciting, I think. So compounding means earning interest not just on your principal, but also on the accumulated interest. So it's like a snowball effect. It leads to exponential growth over time.
That example in the article still blows my mind. A $1,000 investment at 12% annual interest can grow to over $52,000 in 35 years.
Yeah.
That's pretty wild. So it really highlights time is your greatest ally when it comes to investing.
It really is.
Yeah.
And it also underscores why starting early is crucial, because even small, consistent contributions can accumulate significantly over time, especially if you harness the power of compounding.
So how does compounding frequency play into this? Does it make a difference if the interest is compounded monthly versus annually?
Yeah, it absolutely does. More frequent compounding means that your interest is earning interest more often, leading to faster growth.
Yeah.
So while the impact might seem kind of subtle in the short term, it can make a substantial difference over longer periods of time.
So it's kind of like getting paid interest more frequently, so you have more opportunities for your money to multiply.
Precisely. Now let's kind of think about how all of this applies to real estate specifically.
Yeah, let's get practical here. Are there specific calculations that we should be familiar with to make smart real estate decisions?
Definitely. There are several calculations that the article highlights that are incredibly useful, and we're going to be diving into the intricacies of each of those.
Let's do it. I'm ready to crunch some numbers and see how this all plays out in real-world scenarios. Okay, so let's talk about those calculations. The article mentioned future value of a lump sum. What exactly does that mean, and how does it apply to real estate?
So it's a way to kind of project how much an investment will grow over time. So imagine you purchase a rental property today for, say, $200,000. Using the future value calculation, you can actually estimate what that property might be worth in 10, 20, or even 30 years, based on your assumptions about property value appreciation.
So it's kind of like a crystal ball for predicting future property values?
Yeah, not quite a crystal ball because, future market conditions can always shift. But it gives you a valuable tool to assess the potential long-term growth of your investment. So let's say you anticipate a 3% annual appreciation rate for your $200,000 property. Using this future value calculation, you'd find that in 20 years it could be worth over $364,000.
Wow, that's a pretty significant jump. So understanding future value can help investors set realistic expectations about potential returns and also make informed decisions about whether to hold or sell a property down the line.
Exactly. Now, let's kind of flip the script and talk about present value of a lump sum. This one is about determining the current worth of a future cash flow.
Okay, so this is more about looking back in time. Why is that relevant for real estate investors?
It's all about making sure you're paying a fair price today for the potential future value of a property. So let's say you're considering a property that's expected to sell for $500,000 in 15 years. The present value calculation helps you determine how much that future selling price is worth in today's dollars.
And that's where the discount rate comes in, right?
Precisely. The discount rate reflects the rate of return that you could expect on a similar investment. It helps you account for the time value of money and the risk associated with the investment. So using a discount rate of, say, 8%, the present value of that $500,000 future sale price might be around $180,000. This means that paying anything less than $180,000 for the property today could be considered a good deal based on your expectations.
Got it. So present value helps investors make more informed offers on properties by taking into account the time value of money and their desired rate of return. It's kind of like having a financial compass to guide your decision making.
Exactly. Now let's move on to a concept that's particularly relevant for rental properties, and that is the future value of an annuity.
Can you remind me what an annuity is again in the context of real estate?
Sure. So it's a series of equal payments over a set period. So think about your monthly rental income. Each rent payment represents a part of an annuity. The future value of an annuity calculation allows you to project the total value of that stream of income over time.
So if I'm considering buying a rental property, I can use this calculation to estimate how much rental income I could potentially earn over the next 10 or 20 years.
Exactly. And it can help you compare different rental properties and see which one has the potential to generate the most income over your desired holding period.
I see how all of these calculations come together to paint this comprehensive picture of a property's financial potential.
Absolutely. Each calculation provides a different piece of the puzzle, and when you combine them, you gain a much deeper understanding of an investment's potential value.
Speaking of combining calculations, the article mentioned discounted cash flow analysis, or DCF. Is that something we can kind of dive into? It sounds a little complex.
Yeah, it might sound intimidating, but the concept is actually quite straightforward. DCF analysis is simply a way to value an investment by taking into account all of its future cash flows, both incoming and outgoing, and discounting them back to their present value.
So it's like creating a detailed financial forecast for a property, projecting all the money it could generate and all the costs involved over a specific period of time.
You got it. It's a more holistic way to assess profitability than just looking at the initial purchase price. Let's kind of break it down into 3 key steps. First, you need to forecast those future cash flows. This involves making assumptions about things like rental income, operating expenses, and the eventual sale price of the property.
Okay, so there's a little bit of guesswork involved, but you can use historical data and market trends to try to make those projections as accurate as possible, right?
Absolutely. You'll want to research comparable properties, analyze local market trends, and factor in any anticipated changes that could affect those cash flows. Yeah. So things like, changes in the neighborhood demographics or new developments in the area.
So once we have projected those future cash flows, what's the next step?
The second step is choosing a discount rate. Remember, we need to discount those future cash flows back to their present value, and the discount rate represents the minimum rate of return that you require to make that investment worthwhile.
So a higher discount rate means you're demanding a higher return, usually because the investment is seen as being riskier.
Precisely. And this rate will vary depending on your individual investment goals, your risk tolerance, and prevailing market conditions.
Sure.
So once you have your cash flow projections and your discount rate, the final step is bringing it all together.
Okay, so we're basically putting a price tag on the future by figuring out what that stream of cash flows is worth in today's dollars, taking into account our desired rate of return.
Exactly. We discount each year's cash flow back to its present value, and then we sum up all those present values to get the net present value, or NPV, of the investment.
And that NTV is really the key, right? It tells us whether the investment is projected to be profitable or not.
A positive NPV means that the investment is expected to generate a return that exceeds your discount rate, making it potentially profitable. On the other hand, a negative NPV suggests the investment is unlikely to meet your return requirements.
DCF sounds like a really powerful tool for comparing different investment opportunities and seeing which ones have the highest potential return relative to their risk.
It absolutely is. It's a more comprehensive way to analyze real estate deals than just looking at the upfront costs. It forces you to really consider the long-term financial implications of your decisions.
I'm starting to see how mastering these calculations can really give you an edge in the real estate market.
It's like having a secret weapon that allows you to see the true value of a property beyond the surface. And the best part is you don't need to be a math whiz to utilize these tools. There are plenty of resources available, like Excel spreadsheets and online calculators that can do the heavy lifting for you.
That's reassuring. So even if I'm not comfortable with complex formulas, I can still learn to apply these concepts and make smarter investment decisions.
Absolutely. The key is understanding the principles behind the calculations and using the available tools to your advantage.
Okay, we've covered a lot of ground here, from future value to DCF analysis. I'm feeling a lot more confident about analyzing potential deals. Now, before we wrap up this deep dive, I want to touch on one more thing that the article mentions, mortgage calculations. Can we kind of take a quick look at those?
Of course, mortgages are an integral part of real estate for most investors. So understanding the calculations involved is crucial.
Yeah, so let's start with the basics. What are the key things we need to calculate when dealing with a mortgage?
The two most important calculations are the monthly mortgage payment and the down payment required.
Yeah.
Now, these might seem pretty straightforward, but they have a significant impact on your overall investment strategy.
Yeah, I mean, those numbers determine how much cash you'll need up front and how much you'll be paying each month.
Exactly. So let's start with monthly payments. The amount you'll pay each month is determined by three main factors: the loan amount, the interest rate, and the loan term.
So a larger loan or a higher interest rate is obviously going to result in a larger monthly payment. What about the loan term? How does that affect things?
So the loan term is the length of time you have to repay the mortgage. It's typically expressed in years, like 15 or 30 years. A shorter loan term will have higher monthly payments, but lower overall interest costs over the life of the loan. Conversely, a longer loan term will have lower monthly payments, but you'll end up paying more in interest over time.
That's an important trade-off to consider. Choosing the right loan term really depends on your individual financial situation and your investment goals.
Absolutely. Now let's talk about the down payment. This is the portion of the purchase price that you pay up front, and it's typically expressed as a percentage.
So if I'm buying a property for $300,000 and the lender requires a 20% down payment, I'll need $60,000 in cash at closing.
You got it. And the remaining 80% of the purchase price, or $240,000 in this case, would be covered by the mortgage loan.
It's amazing to see how all these calculations kind of intertwine. Like the down payment affects the loan amount, which then influences your monthly payments. And the interest rate and loan term play a role in both calculations as well.
It's all connected. That's why understanding these calculations is so important for making sound real estate decisions. They help you evaluate potential deals, assess affordability, and ultimately determine whether an investment aligns with your financial goals.
This deep dive has been so eye-opening. I'm starting to see how mastering the time value of money is like unlocking a whole new level of understanding in the world of real estate.
It's a game changer for sure. And remember, you don't have to be a financial expert to utilize these concepts. There are tons of resources available to help you.
That's good to hear.
Yeah.
So even if I'm just starting out real estate, I can still learn to apply these principles and make smarter investment decisions.
Absolutely. The key is to start learning, keep exploring, and never stop seeking knowledge. The more you understand the financial mechanics behind real estate, the better equipped you'll be to make profitable investments.
Wow, you've really demystified some complex financial concepts for us today. I think our listeners will walk away with a much deeper understanding of how the time value of money really does impact their real estate decisions.
Yeah, I hope so. It's one of those fundamental principles that can really empower investors to make smarter choices and maximize their returns.
Speaking of empowerment, what's one key takeaway you'd want our listeners to really internalize from our conversation today?
That's a great question. If I had to choose one, I would say don't underestimate the power of time when it comes to investing.
So it's not just about finding the right deal, but it's also about understanding the long game.
Exactly. Sometimes the most profitable investments are those that seem modest at first, but have the potential to grow significantly over time, thanks to compounding and strategic decision-making.
So patience and a long-term perspective are key ingredients for success in real estate.
Absolutely. It's like planting a tree.
Yeah.
You need to nurture it, give it time to grow, and resist the urge to uproot it prematurely.
I love that analogy. It really captures the essence of long-term investing.
And on that note, I want to leave your listeners with a challenge. The next time you're evaluating a potential real estate investment, I encourage you to go beyond the surface numbers. Think about the time horizon. Consider the potential for appreciation and rental income growth. Factor in the time value of money in your calculations and ask yourself, what is the true value of this investment over the long term?
That's a fantastic challenge and a perfect way to wrap up our deep dive into the time value of money in real estate.
It's been a pleasure being here.
The pleasure was all ours. Thank you for sharing your expertise with us.
And to all the listeners out there, keep learning, keep exploring, and keep investing in your future. I'm confident that you have the power to achieve your real estate goals.
And be sure to check the show notes. We'll include a link to the article, Using Time Value of Money for Real Estate Valuation, for anyone who wants to dive deeper into this topic.
It's a great resource.
Thanks for tuning in to the Deep Dive. We'll be back next week with another insightful exploration of the world of real estate.
Until then, happy investing.